Hello, everyone, and welcome back to another episode of the Saigal Seatrade podcast. I am Research Analyst Shruti, your host today, and we are yet again diving deep into the fast changing world of tanker shipping. I'm joined by shipping and commodity expert Mr. Sandesh Ghandat. Welcome back, Sandesh.
Thanks, Shruti. Thanks for inviting me once again. We have something important to discuss, so let's dive in.
Alright, then let's start with the crude tanker market first. What's the story for the last week, Sandesh?
Well, crude tanker markets, specifically the ex-MEG market, last week we saw kind of a mixed but generally softening trend over the week. And early on, there was a holidays across Asia and UK, that kind of a dampen the activity and it contributes to weaker sentiments. During the midweek, we have seen some of the activities. There was an increased inquiries and that uptick emerged as owners resisted softening. But at the same time, we have ample vessel supply that capped any gains in the freight rates. Now, as the week progressed last week, a lengthening tonnage list and multiple offers per cargo, it kind of weighed further on the rates. So geopolitical tensions between India and Pakistan raised concerns, but there was no significant impact. We have not seen any immediate impact. Additionally, we have seen the US tariffs and the crude market contango. It kind of added complexity to the trading behavior. So we expect that in the coming weeks, rates expected to ease further unless and until demand picks up significantly from the Middle East Gulf market. Now that's about the Middle East Gulf market. Let's move on to the West Africa market. So in the West Africa, the market it began expanding forward tonnage and there was a reduced fixing activity, largely due to UK holidays and the vessel redirection towards the US Gulf Coast. The early week sentiments we have observed it was cautiously optimistic for a post-holiday pickups and having said that, as the week progressed, we have seen activity failed to materialize, leading to kind of a sharp decline in the rates. And it was mainly driven by sluggish demand and lengthening vessel lists. We have seen softening trends in the Atlantic, that means in ex-Brazil and Middle East Gulf regions. They further pressured the WAP market and charterers increasingly considered Suezmaxes as more economical option, particularly on UKC bound routes. So as the week progressed towards the end of the week, we have seen the VLCC rates continue to erode and with a little incentive for immediate recovery in the market. If fresh cargoes they will not emerge early next week, the market may face further pressure. However, there is other side of coin too. A surge in the Suezmax usage, it could create a temporary support for VLCCs if the availability tightens. Now coming back to the ex-US Gulf market, here also we have seen the market kind of begin on very steady note with the benchmark route ex-US Gulf to China and then ex-US Gulf to UKC holding firm amid limited fresh inquiries. However, when we move ahead in the week, we observed in the midweek, these sentiments, they quickly shifted as there was a lack of activity in the market, specifically from the Far East due to Golden Week holidays. And, it kind of triggered a softening trend. And then it pressured freight rates and that's why the freight levels declined progressively with ex-Brazil China routes aligned around world scale 62.5 and later by the end of the week they kind of hovered around world scale 59. And it was a clear signing of weaker fundamentals. USG China rates, they also slipped to around 8.65 million amid continued sluggish demand. So we have seen ex-Brazil and ex-US Gulf for voyages that those are going to Far East, specifically to China. Both the freight levels in both the routes, they have declined significantly. So although the MEG experienced a short-lived uptick post-OPEC announcement, its momentum faded and further influencing the Atlantic basin. So with overall inquiries remained limited and bearish sentiment persisting, we expect further rate softening. Unless and until there is significant new demand from the Far East or kind of a rebound in the Brazilian cargoes. Here we have benchmark TD2 and TD3C rates. They both decreased by around 12% and 11% week on week. But they conclude at around world scale 59.88 and world scale 59.95 respectively. So we have a TD15, it also decreased by around 7.94%, and it got settled as world scale 61.22, and then TD22 decreased by 3.35% from 8.84 million to 8.55 million. So talking about Indian market, Indian PSU quoted one VLCC last week, and that was for the early June laycan, and it got covered by 4.7 million, and the voyage was between ex-WAF to West Coast India. Now that's about the VLCC segment. Let me shed some light on Suezmax segment. So in the ex-MEG, that is again Middle East Gulf, last week the market faced a slight pressure. So the sentiments were kind of the same at the start of the week for both VLCC and Suezmax in the Middle East Gulf region. So with an expanding tonnage list weighing on rates, we have seen a significant pressure on the freight rates. Early in the week, conditions were relatively flat, though the ex-MEG West route showed signs of needing further testing. And then as the week progressed, activity remained muted with private and off-market negotiations dominating the landscape. Now the demand for India-bound cargoes continue to support rates and attracting a premium over routes heading to the East Asia. We have seen a reduction in ballasters moving westward, and it kind of increased tonnage availability in the east, which indeed contributing to downward pressure and further influencing weakening rates in the WAF region. So however, owners remain focused on the securing Bashire loading stems, which continue to compare with Aframax vessels for market share. So having said that, by the week's end, we have observed the market steadied with no significant shift, and the tonnage supply appeared balanced with approximately 10 such vessels they expected to open at Indian ports by mid-May. Though some softening may persist due to the current tonnage because it is a surplus, and there was a subdued activity. So a further test of the ex-MEG West route is anticipated, while India-bound demand could continue to offer some support to rates. Now that's about the Middle East Gulf market. Let's move on to the ex-WAF market for Suezmax. So here also the story is kind of the same. Market has been opened with kind of a bearish sentiment, and the market experienced a significant downturn, which was mostly driven by subdued activity and increased tonnage list. So we have seen the benchmark ex-WAF UKC route, it saw notable drops in rates with fixtures concluded well below the prior levels. So a build-up of available vessels with limited cargo and ongoing CPC maintenance, they kind of added a further downward pressure on the market. So the market continued to decline, particularly due to the weak demand and correction after the previous rate surge. We have seen a kind of a shift towards Suezmax vessels due to current VLCC undercutting and offering some market relief when we compare the Suezmax segment with the VLCC. So here we have TD6, it increased 15.6%, and TD20, it decreased by 11.52% week on week, and they both settle at world scale 109.8 and world scale 87.5 respectively. Indian PSU though quoted one Suezmax cargo last week with ex-MEG East Coast India. It got covered around world scale 114. Now talking about the Aframax segment, so ex-MEG the market remained largely subdued throughout the last week with minimal fixtures and all cargoes mostly covered. So despite the tight supply, sporadic demand and lack of fresh inquiries, it kept rates within the narrow band. We have seen the TD8 index, it fluctuates slightly and it kind of a reflecting marginal decline from the earlier levels. And then we have a XC, that is Southeast Asia region. The market remained soft throughout the last week, and it was marked by subdued activity and minimal cargo inquiries. Here also we have seen TD14 index decline steadily and reflecting persistent downward pressure. We have another benchmark route, that is TD8. It decreased by 0.43% week on week, and it concluded around world scale 149.07, and then we have a TD14, it is decreased by 2.29% week on week to settle at world scale 117.31.
Thank you, Sandesh, for that update on the crude tanker market. Moving on to the CPP segment, what's going on in that market, Sandesh?
So in the LR1 segment, freight rates for AJ Japan TC5 route, they kind of edged slightly higher last week, rising from world scale 0.32 points marginally, and it got settled at 134.38. At the same time, TC was assessed at around just higher than $18,500 per day, but it was a 3.81% decrease. In the LR2 market, the market came under renewed pressure because rates here for the AG Japan TC1 routes fell substantial by 10.55 world scale points, and they concluded around world scale 112.78 points week on week. And it is a signaling weakening fundamentals. So the impact on TCs was also pronounced because they kind of plunged by around 4,500, just below $4,500 per day, or 25.66% week on week, and it's a significant decrease, and they closed around just below $22,000 per day. In the MR segment, the story is kind of the same. Here also the rates TC12 experienced a mild correction. They declined by world scale 2.03 points to reach around 146.41 week on week. It was majorly due to, softening of demand on the weekly basis, and then they have a higher operational cost that eroded returns.
Sandesh, let me just interrupt you here for a bit. As the India-Pakistan tensions escalate, what's your assessment for the CPP tanker segment?
As the tensions between India and Pakistan escalate sharply, the heart of South Asia's refined product supply chain is beginning to show cracks, and it may or it will cast a long shadow over the region's CPP export if escalation will continue. You know what? India is a critical supplier of gasoline derivatives and jet fuel exports, and these exports reached around 1.5 million barrels per day. And they are now seeing its western ports disrupted by security drills, blackouts, and an atmosphere of heightened alert. So ports like Kandla and Mundra, they briefly went dark midweek last week, but resumed operations a day later, but not without raising any red flags across global freight desk and insurance underwriters. While refinery operations remain unaffected, with India processing around 23.94 million metric tons, or we can say that 5.6 million barrels per day in March 25, the operating rates remain at robust 110%. And even outpaced last year's levels, as the ripple effect from the port side's uncertainties unsettling CPP trade flows. The Arabian Sea already is a designated HRA and has now seen its AWRP surge by 15 to 25%, as insurance provider kind of elevate the threat level from low to moderate. Tanker owners and the tankers are not yet steering clear, but many are in process of adjusting routes avoided within the waters of 200 nanomiles of Indian coast, opting instead of detours via Minicoy Island or Gaul and onward past Ras Al Had, inflating voyage cost and bunker consumption. For the charterers and end receivers already reeling from the sky-high premiums in the Red Sea and Persian Gulf, so the looming possibility of Indian ports being added to the AWRP list, this could mean that there may be an additional cost of around 0.2 million to 0.5 million per voyage, a burden that could swell to around $1 million for the ships also transiting the Red Sea. And it kind of translating to an alarming $50 to $60 metric ton surge in the CPP cargo landed pricing. In simpler terms, any vessel for any product tanker going from Mundra or Kandla to Europe, they will have to pay additional $1 million, and that is a $50 to $60 high cost on the landed pricing of CPP cargo in Europe. So the knock-on effects are already emerging as freight rates in the Singapore, it could spike as ships scheduled for Pakistan now kind of rerouted to Colombo or Singapore, or reducing ballast tonnage in the States and tightening vessel supply. So, despite geopolitical storm clouds, Indian refiners, specifically in sensitive border states like Gujarat, Punjab, and Rajasthan, are accounting for nearly 45% of annual refinery capacity. But this capacity are operating with the steadfast resolve under stepped up security. Indian fuel availability is also stable, with IOC maintaining ample stocks and assuring the public there is no cause for panic buying. Domestically, India kind of remains well supplied with gasoline and gas oil levels. They are around 12 to 14% higher above the 5-year average. And then we have a jet fuel or kerosene. They are also nearing historical norms, buoyed by strategic reserves that cushion any potential supply shocks. But globally, the market is watching a full scale escalation, which has not happened as of today. But if that is happening, it could make the Arabian Sea another geopolitical theater to avoid, much like the Red Sea.
Alright, so let's move on to the LPG segment now. Please tell our audience what is going on in the LPG market, Sandesh.
Well, the East of Suez VLGC market saw an active week with reported fixtures reaching double digit by the week's end. So here most of deals were for late May laycans loading from the AG, Yanbu and then Australia. So rates they climbed steadily from the mid 40s to mid 50s per metric ton, and they kind of peaked at around $65 per metric ton for a full butane Ras Tanura Chiba cargo, and it was fixed on the last day of last week. Early week last week we have seen India bound cargoes were done at $47 per metric ton, but it later rose by around $10 and hovered around $57 per metric ton. So as the market shift focus to early June dates, owners are kind of hopeful recent momentum will continue in the future also. But with a few ships still open for end May, rates stability will depend on the fresh cargo demand. So that's about the east of Suez. So in the west of Suez VLGC market, we saw a late week surge in activity with flurry of fixtures reported on the last day of week. They were specifically for June laycans, June USG laycans. So this spike in the fixing, it kind of pushed rates to around $108 per metric ton basis Houston Chiba via Panama. And despite a weak arbitrage economics and limited netbacks for traders, freight levels have held firm and they were kind of supported by tight vessel availability through mid-June. Momentum from the east and the charter's urgency to secure tonnage, it contributed to firmer sentiments. So looking ahead, owners remain optimistic, though charters may hope for more relate availability as some ships begin routing via the Cape.
Well, thank you, Sandesh, for giving an update on the crude, CPP and the LPG segments.
Thanks, Shruti, for inviting me once again. It's always been pleasure to share the market sentiments with you and our audience.
Well, that brings us to the end of this week's episode. And to all our listeners, do not forget to share and subscribe to our podcast. Until next time, navigate safely and stay tuned.